Good afternoon. This is Nick Stogberg with Black Swan. It's a good news day. We're going to talk briefly about interest rates. The Fed just announced here a couple hours ago that they're doing a quarter point cut today, and also that they're going to halt quantitative tightening or unwinding some of the assets on their balance sheet. Both moves are going to improve the interest rate environment for real estate investors and consumers alike. So, we're going to talk briefly about some of the predictions we made in the past in some of our previous webinars, and we'll include a link to our most recent fund update webinar. Let's take a quick look at what this announcement is, why we were able to predict it, what the future might hold, and ultimately what that means for you as an investor, either with Black Swan or an investor in real estate yourself. So if you're ever wondering, what the odds are of a future Fed meeting, you can check out this CME Fed Watch tool. And this is a slide from the update webinar we did on our private equity funds performance just a week ago. And basically, the CME Fed Watch tool, it just looks at the futures market. And people, if you want to know how someone truly feels about something, ask them to put money on it. So this is the futures market. This is people who are placing huge bets on likely future policy decisions from the Federal Reserve. And so a week ago, it was projected there was a 98.9% chance of the Fed announcing a rate cut today. Now, the Fed values an orderly economy. They don't want to see, sharp ups and downs and surprises. So they watch this tool just the same as other people do. And ironically, if this tool is going far askew from what they think their actual decisions will be, they'll often do a little press release, or one of the Fed governors might do an interview with Bloomberg or something where they just say something like, yeah, it sure seems like the market thinks a bunch of cuts are coming, but I think it's less likely than people believe. And then all of a sudden the CME Fed Watch tool changes. So no one really knows what the future holds. And if you look at like the Fed dot plot, as we talk about sometimes in the past, where they do anonymous surveys of the Fed Board of Governors, they don't even necessarily know exactly what the future holds. These are just our best guesses. And so a week ago, there was a 98.9% chance of a Fed rate cut occurring at the FOMC meeting today. And lo and behold, that's precisely what happened. It's kind of funny, though. So a week ago, the market predicted a 96% chance of there being a second rate cut before the end of the year. But if we go over to the Fed Watch tool today, those odds have changed quite a bit. So you can see it used to be a 96% chance. Now it's only a 65% chance of there being a rate cut here in December. Why would that be? Well, first of all, because the rate cut that happened today. If for some reason it didn't happen today, that would have increased the chances of a rate cut happening at the next meeting. And then also because the Federal Reserve did announce their decision to halt quantitative tightening. So they have kind of two tools in their toolbox. They do quantitative easing. They're buying government bonds or mortgage-backed securities, and that drives down the interest rate when they're doing quantitative easing. Quantitative tightening is when they're selling those bonds, which increases the interest rate that you would pay if you locked in a mortgage on a new personal home or investment property today. Has a huge impact on bond yields, treasury yields, and there's trillions of dollars on their balance sheet. So it's a huge impact. The prime rate is typically directly determined by the Federal Reserve interbank lending rate, other short-term benchmarks like SOFR. But the treasury rates are hugely impacted by whether or not the Fed is pursuing quantitative easing or quantitative tightening. Right now, they're doing neither. They're going from a tightening cycle where they were selling assets off their balance sheet, deliberately increasing interest rates, to putting it on pause. It's not quantitative easing, but it is quantitative tightening. So this past webinar, go check out the replay here. But we said, don't ever believe what Trump says. Believe what he does. And the U.S. Treasury has been buying short bonds, short-term bonds, like one-year bonds instead of 30-year bonds, which meant that the Treasury had a belief that interest rates in the future would be lower than the interest rates today. And so, lo and behold, that is precisely what's happened. And you can set yourself up for success by putting yourself in the way of opportunity, of good fortune. And let's just talk about what does this mean? What does it mean to be in a place where you can succeed, knowing that you might be going into a declining rate environment, to protect yourself from the chance that rates could go up, while also being able to benefit from rates going down. And how does this interest rate change impact a real estate investment? So here's Hamptons Townhomes. I love this. This is owned in Fund 2. It's a relatively small property. This is the smallest property in Fund 2. So I think it's very, very simple, easy to understand scenario. We bought this a little under 3 years ago. So this is a slide from our Q2 performance update. We purchased this for 1.55 million, put down $250,000, and then had very favorable seller carry in conjunction with a first lien from a awesome regional bank that we worked with on this deal. Spent about $100,000 on renovations, and then when we got done, it was worth somewhere between $2 and $2.5 million, and that's despite price declines in the industry. One of the most critical implications to rates going up or rates going down is that when rates go down, the value of real estate goes up, and it goes up significantly. So the value of multifamily real estate, apartment buildings will go up, and the value of single family homes will go up as well. That halts to quantitative tightening. The Fed has a massive number of mortgage-backed securities from American single family homes on their balance sheet. And already we're seeing that interest rates for 30-year mortgages are at kind of multi-year lows right this second. So looking at how this impacts this particular multifamily investment here, we created about $500,000 of equity in this deal in less than 3 years. So we generated approximately a 50% annual rate of return, and it was generating about $41,000 of cash flow on a trailing 12-month basis. When we refinanced this earlier this year, or about a 16% cash-on-cash rate of return. This was a home run deal. However, when we expired, when our financing matured, and that interest rate that we locked in before expired, we were previously at a 5% interest rate on 25-year amortization, and the lending environment was a little less favorable earlier this year than it was today, and it was a lot less favorable than it was 3 years ago when we originated this loan. We're refinancing into a higher interest rate, shorter amortization loan. And what that means is went from basically $41,000 a year of cash flow on a relatively modest property to essentially zero cash flow, and creating a massive amount of equity, of value in this property, but being able to cash out relatively little in terms of that actual equity. I have this note here. If rates declined by less than 2%, we could have otherwise achieved a full cash out refi on this particular asset, had an infinite rate of return as we described it at that point. So if we were to go execute the same refinance today, it's very likely we could get approximately a 6.25% interest rate on this loan from a regional bank. It's not exactly like a 1-to-1, ratio between, Fed rate cuts and the interest rate, the coupon rate on a loan that you get. But in this case, there's been I would say about a half point reduction in the loan rate, the coupon rate that we can get on multifamily properties today. Around the same time, there's been about a half point decline in the Fed rate. So if we were to execute this exact same refinance, I'm very confident we could get a 6.25% rate. And that would allow us to do, probably about a 30% cash out refinance on this particular asset. So instead of getting no money back from that new financing event, we could get about 30% of all of our invested capital back from this particular investment. And I would say this property is relatively representative of where the industry as a whole is at. Certainly representative of a lot of properties in the Black Swan portfolio. Like, things are okay. We're adding massive value, improving the income of the asset, and if rates decline just a little bit, it is a huge difference in our ability to achieve, significant cash out refinance events and deliver, radically greater returns to our investors. So we are celebrating today. This has been a fantastic day. We're so excited to see this Fed rate cut happen, and we hope we get one more here in the near future. It seems like the market is pricing in decent probabilities that we'll see another Fed rate cut sometime here in the immediate future. Maybe not as certain as it was in December. But again, that's because the Fed is pursuing a quantitative tightening policy. Or I'm sorry, they're putting a halt to their quantitative tightening, which is going to hopefully reduce treasury rates and lower interest rates sooner rather than later. So could not be more excited about this news, and we hope that you're all celebrating with us.